Question 1. An auditor is assessing the anti-bribery management system of a multinational corporation. During the review of third-party relationships, the auditor examines the due diligence file for a newly engaged logistics provider operating in a jurisdiction known for high corruption levels. The file contains basic company registration details and a signed contract, but lacks evidence of verification of the provider's ultimate beneficial owners and a documented risk assessment that explicitly categorizes the engagement as high risk, despite the operational context. What is the most appropriate conclusion for the auditor to draw regarding the effectiveness of the due diligence process for this specific third party? Option A. The due diligence process requires further enhancement to include background checks on key personnel of the third party, but the current documentation is acceptable for initial engagement. Option B. The due diligence process is adequate as the basic registration details and contract are present, indicating a reasonable level of scrutiny. Option C. The due diligence process is ineffective for this high-risk third party due to missing critical verification elements and a documented risk assessment. Option D. The due diligence process is compliant with ISO 37001:2016 because the organization has a policy for due diligence, regardless of the specific findings. The correct answer is C. The due diligence process is ineffective for this high-risk third party due to missing critical verification elements and a documented risk assessment. Explanation. The scenario describes an auditor reviewing a company's due diligence process for third parties. The auditor has identified a high-risk third party with whom the company has a significant contract. The company's due diligence documentation for this third party is incomplete, lacking evidence of verification of beneficial ownership and a clear risk assessment outcome. ISO 37001:2016 Clause 7. 2. On due diligence requires that organizations conduct due diligence on third parties commensurate with the risks identified. This means that for high-risk third parties, the due diligence process must be more rigorous and thorough. The absence of verification of beneficial ownership and a clear risk assessment outcome directly indicates a failure to meet the requirements for high-risk third parties. Therefore, the auditor would conclude that the due diligence process is not effective for this specific high-risk relationship, representing a nonconformity. The auditor's role is to assess compliance with the standard and the organization's own policies and procedures. A lack of critical information for a high-risk entity signifies a gap in the control environment designed to prevent bribery. The auditor must report this as a finding that requires corrective action to ensure the due diligence process adequately addresses identified risks. Question 2. During an audit of a multinational corporation with a complex organizational structure, including several wholly owned subsidiaries and joint ventures operating in diverse regulatory environments, what is the primary consideration for an ISO 37001:2016 auditor when evaluating the documented scope of the anti-bribery management system? Option A. Verifying that the scope aligns with the organization's primary revenue-generating activities, regardless of subsidiary operations. Option B. Ensuring the scope explicitly covers all entities, business units, geographical locations, and activities that could present bribery risks, with clear justification for any exclusions. Option C. Assessing if the scope exclusively includes direct employee interactions and excludes third-party relationships to simplify compliance efforts. Option D. Confirming that the scope is limited to jurisdictions where anti-bribery laws are strictly enforced, as per the organization's legal counsel's advice. The correct answer is B. Ensuring the scope explicitly covers all entities, business units, geographical locations, and activities that could present bribery risks, with clear justification for any exclusions. Explanation. The core principle of defining the scope of an anti-bribery management system, ABAMS, under ISO 37001:2016 is to ensure it covers all relevant bribery risks faced by an organization. This involves considering the entire organization, including all its entities, business units, functions, and geographical locations where bribery risks might exist. Furthermore, the scope must encompass all activities undertaken by the organization, especially those that could expose it to bribery, such as dealings with public officials, agents, intermediaries, and third parties in high-risk jurisdictions or sectors. The standard emphasizes that the scope should be documented and justified. When an organization operates through subsidiaries or has significant partnerships, the ABAM scope needs to address these relationships to prevent circumvention of controls. The exclusion of any significant part of the organization or its activities without proper justification would render the ABAMs incomplete and potentially ineffective in managing bribery risks comprehensively. Therefore, an auditor must verify that the defined scope is sufficiently broad to encompass all foreseeable bribery risks, aligning with the organization's structure, operations, and the external environment in which it operates, and that this scope is clearly articulated and understood. Question 3. During an audit of a multinational corporation's anti-bribery management system, an auditor is reviewing the documented process for identifying and addressing the needs and expectations of interested parties. The organization has identified its shareholders, employees, and customers as key stakeholders. However, the auditor notes that the process does not explicitly consider the potential impact of regulatory bodies in countries where the company has significant operations, nor does it address the expectations of non-governmental organizations, NGO, that monitor corporate ethical conduct in high-risk markets. Which of the following best reflects the auditor's finding regarding the organization's understanding of interested parties relevant to ISO 37001-2016? Option A. The organization has not adequately considered the full spectrum of interested parties whose needs and expectations are relevant to the effective implementation of an anti-bribery management system, particularly those with regulatory or oversight roles in high-risk environments. Option B. The organization's identification of interested parties is sufficient as it includes all primary stakeholders directly involved in commercial transactions with the company. Option C. The organization's focus on shareholders, employees, and customers is a strategic choice that aligns with its business objectives, and external regulatory bodies are implicitly covered by legal compliance. Option D. The organization's understanding of interested parties is robust, as it has documented its relationships with all internal stakeholders and its primary customer base. The correct answer is A. The organization has not adequately considered the full spectrum of interested parties whose needs and expectations are relevant to the effective implementation of an anti-bribery management system, particularly those with regulatory or oversight roles in high-risk environments. Explanation. The fundamental principle of identifying and understanding the needs and expectations of interested parties under ISO 37001-2016, specifically concerning anti-bribery, requires an auditor to assess how effectively an organization has considered external and internal stakeholders who can affect or be affected by its anti-bribery efforts. This involves more than just listing parties. It demands an evaluation of the relevance of their needs and expectations to the anti-bribery management system, ABAMS. For instance, while a general customer might have expectations about product quality, an interested party in the context of anti-bribery might be a foreign government regulator in a jurisdiction where the organization operates, whose expectations directly relate to compliance with local anti-bribery laws and the organization's commitment to ethical business practices. Auditors must verify that the organization has a systematic process for identifying these parties, determining which of their needs and expectations are relevant to the ABAMS, and ensuring these are incorporated into the system's design and operation. This includes considering legal and regulatory requirements, which are paramount in anti-bribery efforts, as well as the expectations of investors concerned about reputational risk, employees who are expected to uphold ethical standards, and business partners who may be subject to third-party due diligence. The focus is on the impact of these expectations on the organization's ability to prevent, detect, and respond to bribery. Question 4. An auditor is reviewing the ABAM scope for a multinational corporation, Global Synergy Inc., which operates in diverse regulatory environments and has a complex organizational structure including wholly owned subsidiaries, joint ventures with local partners in high-risk regions, and a network of third-party agents. Global Synergy Inc. has proposed an ABAM scope that covers only its headquarters and its direct operations in its home country, excluding all foreign subsidiaries, joint ventures, and third-party relationships. What is the most appropriate auditor conclusion regarding this proposed scope in relation to ISO 37001-2016 requirements? Option A. The proposed scope is valid if the majority of the organization's revenue is generated from its home country operations, as this reflects the primary business focus. Option B. The proposed scope is acceptable if the organization can demonstrate that bribery risks in excluded areas are demonstrably lower than in the covered region. Option C. The proposed scope is inadequate as it fails to encompass all entities and business relationships where bribery risks may exist, contravening the standard's intent for comprehensive risk coverage. Option D. The proposed scope is sufficient provided that the organization has a separate, less formal anti-bribery policy for its foreign operations and third-party agents. The correct answer is C. The proposed scope is inadequate as it fails to encompass all entities and business relationships where bribery risks may exist, contravening the standard's intent for comprehensive risk coverage. Explanation: the determination of the scope of an anti-bribery management system, ABAMS, under ISO 37001-2016 is a foundational step that defines the boundaries of the system's application. Clause 4.2 of the standard, understanding the organization and its context, and Clause 4.3, determining the scope of the anti-bribery management system, are critical here. The scope must consider the organization's external and internal issues relevant to preventing bribery, as well as the requirements of interested parties. Furthermore, the scope should encompass all levels, functions, and operations of the organization, including any entities over which it has effective control, where bribery risks are present. This includes subsidiaries, joint ventures, and significant business relationships. The principle is to establish a comprehensive system that addresses bribery risks across the entirety of the organization's activities and relationships where such risks can manifest, rather than arbitrarily limiting it. This aligns with the intent of the standard to provide reasonable assurance against bribery. Question 5. When auditing an organization's anti-bribery management system, in accordance with ISO 37001-2016, what is the primary focus of the auditor when evaluating the performance evaluation activities under Clause 9, particularly concerning the effectiveness of controls and compliance with relevant anti-bribery legislation like the U.S. Foreign Corrupt Practices Act? Option A. Verifying that the organization systematically monitors, measures, analyzes, and evaluates the performance and effectiveness of its ABAMS, including the efficacy of controls in mitigating identified bribery risks and ensuring adherence to legal and regulatory obligations. Option B. Ascertaining that the organization has obtained external certification for its ABAMS from an accredited third-party body and has publicly disclosed its anti-bribery policy. Option C. Ensuring that the organization has implemented a whistleblower hotline and has received a minimum number of reports from employees regarding potential bribery incidents within the past fiscal year. Option D. Confirming that the organization has conducted a comprehensive gap analysis against all clauses of ISO 37001-2016 and has documented a plan to address any identified deficiencies. The correct answer is A. Verifying that the organization systematically monitors, measures, analyzes, and evaluates the performance and effectiveness of its ABAMS, including the efficacy of controls in mitigating identified bribery risks and ensuring adherence to legal and regulatory obligations. Explanation: the effectiveness of an anti-bribery management system, ABAMS, is evaluated through various performance indicators and monitoring activities. Clause 9 of ISO 37001-2016, Performance Evaluation, mandates that the organization shall monitor, measure, analyze, and evaluate the performance of its ABAMS. This includes assessing the effectiveness of controls, the achievement of objectives, and compliance with legal and regulatory requirements. When an auditor reviews the performance evaluation of an organization's ABAMS, they must ascertain that the organization has established processes for identifying and assessing bribery risks, the effectiveness of implemented controls in mitigating these risks, and the overall compliance with the standard and applicable anti-bribery laws such as the UK Bribery Act 2010 or the U.S. Foreign Corrupt Practices Act, FCPA. Key aspect of this evaluation is to determine if the organization has established clear metrics and key performance indicators, KPI, related to bribery prevention, detection, and response, and if these are regularly reviewed and acted upon. For instance, tracking the number of reported concerns, the timeliness of investigations, the completion rate of anti-bribery training, and the outcomes of risk assessments are crucial. The auditor's role is to verify that the data collected is analyzed to drive improvements in the ABMs, ensuring that the system is not merely in place, but is actively functioning to prevent and detect bribery. The focus is on the systematic review of performance data to identify trends, root causes of nonconformities, and opportunities for enhancing the ABM's resilience and efficacy in preventing corrupt practices. Question 6. When conducting an audit of an organization's anti-bribery management system against ISO 37001-2016, and considering the organization operates in multiple jurisdictions with varying legal frameworks, what specific aspect of international anti-bribery conventions, such as the OECD Anti-Bribery Convention or the UN Convention Against Corruption, UNCAC, is most critical for the auditor to verify regarding the organization's commitment to preventing the bribery of foreign public officials? Option A. The organization has secured formal endorsements from signatory countries of the OECD Anti-Bribery Convention for its anti-bribery compliance program. Option B. The organization has implemented a mandatory annual legal review of all foreign subsidiaries' compliance with the specific bribery laws of their respective host nations, without direct reference to international conventions. Option C. The organization has established a dedicated international liaison office to monitor foreign government policy changes relevant to anti-bribery laws. Option D. The organization's documented policies and procedures explicitly prohibit the offering, promising, or giving of bribes to foreign public officials, directly or indirectly, in accordance with the definitions and scope outlined in these international instruments. The correct answer is D. The organization's documented policies and procedures explicitly prohibit the offering, promising, or giving of bribes to foreign public officials, directly or indirectly, in accordance with the definitions and scope outlined in these international instruments. Explanation. The OECD Anti-Bribery Convention, ratified by numerous countries, mandates criminalization of bribery of foreign public officials. Article 1 of the Convention defines this offense, requiring parties to take measures necessary to establish that the bribery of a foreign public official is a criminal offense. The UN Convention Against Corruption, UNCAC, while broader in scope, also addresses bribery of foreign public officials in Article 16. An auditor's role is to assess conformity with the ISO 37001 standard. ISO 37001, in turn, requires organizations to implement controls that align with applicable anti-bribery laws and conventions. Therefore, when assessing an organization's compliance with ISO 37001, particularly concerning its commitment to preventing bribery of foreign public officials, an auditor must consider whether the organization's policies, procedures, and training reflect the obligations imposed by these international instruments. The conventions focus on the *act* of offering, promising, or giving a bribe to a foreign public official, directly or indirectly, is a core element that an ISO 37001 compliant program must address through its preventative measures and internal controls. The specific requirement for an auditor to verify the existence of mechanisms to detect and report such acts, irrespective of whether a bribe was actually paid or received, is crucial for demonstrating a robust anti-bribery management system that aligns with international legal frameworks. Question 7. When an organization aims to enhance its anti-bribery controls by reducing the risk of improper payments through intermediaries, and has set an objective to decrease the number of high-risk third-party engagements by 15% within the next fiscal year, what is the most critical element to include in the corresponding action plan to ensure its effectiveness and alignment with ISO 37001-2016 principles? Option A. The establishment of a dedicated whistleblower hotline that is advertised internally and externally, ensuring anonymity and providing clear procedures for reporting suspected bribery incidents. Option B. A broad commitment from senior management to foster an ethical culture throughout the organization, including regular town hall meetings discussing the importance of integrity. Option C. A comprehensive review of all existing third-party contracts to identify any potentially ambiguous clauses that could be misconstrued as facilitating bribery, with a focus on legalistic interpretations. Option D. Detailed identification of specific activities, necessary resources, assigned responsibilities, and measurable milestones for each stage of the reduction process, alongside defined methods for monitoring progress and evaluating outcomes against the objective. The correct answer is D. Detailed identification of specific activities, necessary resources, assigned responsibilities, and measurable milestones for each stage of the reduction process, alongside defined methods for monitoring progress and evaluating outcomes against the objective. Explanation: the core of developing effective action plans to achieve anti-bribery objectives, as mandated by ISO 37001, 2016, lies in a systematic and measurable approach. Clause 6. 2. Objectives of the anti-bribery management system and planning to achieve them emphasizes the need for objectives to be specific, measurable, achievable, relevant, and time-bound, SMART. When an organization sets an objective, such as reducing the number of high-risk third-party engagements by 15% within the next fiscal year, the action plan must detail the specific steps required. This involves identifying the resources needed, assigning responsibilities, and establishing timelines for each step. For instance, the action plan might include steps like updating the third-party due diligence questionnaire, conducting enhanced due diligence on 20% of existing high-risk third parties, and implementing a new training module for procurement staff on identifying red flags in third-party relationships. The plan must also define how progress will be monitored and evaluated. This includes setting key performance indicators, KPI, that directly relate to the objective, such as the percentage of updated due diligence questionnaires completed, the number of enhanced due diligence reports finalized, and the completion rate of the training module. Furthermore, the action plan should incorporate mechanisms for review and adjustment, ensuring that the plan remains relevant and effective in the face of changing circumstances or emerging risks. The process involves not just the creation of the plan, but also its communication, implementation, and ongoing management to ensure the objective is met. Question 8. An auditor is assessing an organization that conducts extensive manufacturing operations in Southeast Asia, a region characterized by a high perception of corruption and lacks local enforcement. The organization's parent company is publicly traded on a major U.S. stock exchange and has its primary corporate headquarters in London, United Kingdom. Given this structure, which foundational anti-bribery legal frameworks principles would be of paramount importance for the auditor to prioritize when evaluating the effectiveness of the organization's anti-bribery management system and associated controls? Option A. The principles and enforcement mechanisms of the United Nations Convention Against Corruption, UNCAC. Option B. The principles and enforcement mechanisms of the U.S. Foreign Corrupt Practices Act, FCPA. Option C. The principles and enforcement mechanisms of the Organization for Economic Cooperation and Development, OECD, Anti-Bribery Convention. Option D. The principles and enforcement mechanisms of the local anti-corruption laws of the Southeast Asian nation, where operations are concentrated. The correct answer is B. The principles and enforcement mechanisms of the U.S. Foreign Corrupt Practices Act, FCPA. Explanation: the core of this question lies in understanding the extraterritorial reach and specific provisions of major anti-bribery legislation when auditing an organization's compliance program. The UK Bribery Act 2010, for instance, has a broad scope, covering bribery of foreign public officials and the offense of failure to prevent bribery, which applies to commercial organizations. The U.S. Foreign Corrupt Practices Act, FCPA, also has extraterritorial jurisdiction, primarily focusing on anti-bribery provisions for issuers, domestic concerns, and certain foreign companies. When auditing an organization that operates internationally, an auditor must consider how these laws might apply to the organization's activities, even if the primary business is conducted elsewhere. The scenario involves an organization with significant operations in a country with weak anti-corruption enforcement, but where the organization's parent company is listed on a U.S. stock exchange and has its headquarters in the UK. This dual connection immediately brings both the FCPA and the UK Bribery Act into play. The FCPA anti-bribery provisions apply to issuers and domestic concerns, and its accounting provisions apply to issuers. The UK Bribery Act Section 7, the offense of failure to prevent bribery, applies to commercial organizations, which includes entities incorporated in the UK or carrying on a business in the UK. Given the parent company's US listing and UK headquarters, both statutes are relevant. The FCPA prohibits bribing foreign officials to obtain or retain business. The UK Bribery Act prohibits offering, promising, giving, or accepting bribes, and also the corporate offense of failing to prevent bribery. An auditor must assess if the organization has controls in place to detect and prevent bribery that could violate either of these laws, regardless of the local enforcement environment. The question asks which legal frameworks principles would be most critical for an auditor to focus on to ensure the organization's compliance, considering its international footprint and parent company's domicile and listing. The FCPA broad reach, encompassing issuers and domestic concerns, and its focus on corrupt payments to obtain or retain business, coupled with the UK Bribery Act's strict liability offense for failure to prevent bribery, means an auditor must consider both. However, the question asks which would be most critical. The FCPA accounting provisions, requiring accurate books and records and internal controls to prevent bribery, are particularly stringent for U.S.-listed entities. The UK Bribery Act Section 7, while also significant, often requires demonstrating that adequate procedures were in place to prevent bribery, which is a defense. The FCPA emphasis on preventing the act of bribery itself through robust controls and its broad applicability to the organization's structure, U.S. listing, makes its principles paramount for an auditor assessing risk and control effectiveness in this multinational context. Therefore, the principles of the U.S. Foreign Corrupt Practices Act are most critical for an auditor to focus on in this specific scenario due to the parent company's U.S. listing and the Act's comprehensive approach to bribery and record-keeping for issuers. Question 9. An auditor is reviewing the implementation of an anti-bribery management system at a multinational logistics firm, Global Freight Forwarders. The firm's CEO has delegated the responsibility for ensuring compliance with anti-bribery policies in the South Asian region to the regional director, Mr. Rajesh Sharma. During the audit, it is discovered that Mr. Sharma has limited prior experience with anti-bribery legislation and has not received specific training on the company's anti-bribery policy or the nuances of conducting due diligence on third parties operating in that region. Furthermore, the budget allocated to Mr. Sharma's office for compliance activities is significantly lower than that of other regions. Based on ISO 37001-2016 requirements, what is the primary deficiency in the delegation of authority for anti-bribery compliance in this scenario? Option A. The regional director was not explicitly prohibited from accepting gifts, which is a critical omission. Option B. The audit scope did not include a review of third-party due diligence procedures in the South Asian region. Option C. Insufficient competence and resources allocated to the delegate for effective oversight. Option D. The CEO failed to establish an anti-bribery policy, rendering the delegation invalid. The correct answer is C. Insufficient competence and resources allocated to the delegate for effective oversight. Explanation: ISO 37001-2016 Clause 5. 2. Leadership and commitment mandates that top management shall demonstrate leadership and commitment with respect to the anti-bribery management system. This includes ensuring that the organization's anti-bribery policy and objectives are established and that the necessary resources are made available. Clause 5. 3. Roles, responsibilities, and authorities specifies that top management shall ensure that roles, responsibilities, and authorities for relevant positions are assigned, communicated, and understood within the organization. When delegating authority for anti-bribery compliance, top management must ensure that the individuals to whom authority is delegated have the competence, understanding of the policy and objectives, and the necessary resources to effectively implement and oversee anti-bribery controls within their designated areas of responsibility. This delegation must be documented and clearly communicated to prevent ambiguity and ensure accountability. The effectiveness of this delegation is a key audit point, as it directly impacts the operationalization of the anti-bribery management system. An auditor would assess whether the delegated individuals are aware of their responsibilities, possess the required knowledge of relevant anti-bribery legislation, such as the UK Bribery Act 2010 or the US Foreign Corrupt Practices Act, and have the authority to implement corrective actions. The auditor would also examine evidence of communication of these responsibilities and the provision of adequate training and resources. The ultimate goal is to ensure that the responsibility for anti-bribery compliance is integrated into the day-to-day operations and decision-making processes at all relevant levels. Question 10. When assessing an organization's anti-bribery management system for conformity with ISO 37001-2016, what is the most comprehensive basis for an auditor to determine the necessary competence of personnel involved in key anti-bribery functions, such as procurement or sales, beyond basic job descriptions? Option A. Evidence of successful completion of general compliance training programs, regardless of specific anti-bribery content or practical application. Option B. A documented competency framework that specifies required knowledge of bribery risks, relevant legal statutes, e.g., FCPA UK Bribery Act, ISO 37001-2016 requirements, and practical auditing skills, supported by records of education, training, and experience. Option C. A statement from the organization's Human Resources Department confirming that all employees possess general ethical conduct and have signed a code of conduct. Option D. The number of years of service an employee has within the organization, assuming longer tenure equates to greater understanding of internal controls. The correct answer is B. A documented competency framework that specifies required knowledge of bribery risks, relevant legal statutes, e.g., FCPA UK Bribery Act, ISO 37001-2016 requirements, and practical auditing skills, supported by records of education, training, and experience. Explanation: ISO 37001-2016 Clause 7.2 outlines the requirements for competence. It mandates that an organization shall determine the necessary competence for personnel who affect the performance of the anti-bribery management system, and whose work can contribute to the achievement of the anti-bribery policy and objectives. This determination involves considering education, training, and experience. For an auditor specifically, the competence must encompass an understanding of bribery risks, relevant legal and regulatory frameworks such as the UK Bribery Act 2010 or the U.S. Foreign Corrupt Practices Act, FCPA, the principles and requirements of ISO 37001-2016 itself, and auditing techniques. Crucially, it also involves the ability to apply this knowledge in practice to identify nonconformities and opportunities for improvement within an organization's anti-bribery management system. The process of determining competence should be documented, and the effectiveness of the chosen personnel should be evaluated. Question 11. During an audit of a multinational corporation's anti-bribery management system, an auditor is examining the implementation of Clause 8.5, which addresses making anti-bribery commitments known. The organization has a comprehensive anti-bribery policy and has set ambitious objectives for reducing bribery risks in its high-risk jurisdictions. However, the auditor observes that the policy is only available on the company intranet, and the objectives are communicated internally through a single email announcement at the beginning of the fiscal year. Which of the following approaches would an auditor consider most indicative of a robust implementation of Clause 8.5? Demonstrating that commitments are effectively made known to relevant parties, including external stakeholders where appropriate. Option A. The organization maintains a documented anti-bribery policy and has internal procedures for its review, but makes no specific provisions for external communication or explicit acknowledgement of understanding from employees. Option B. The organization relies solely on its legal department to periodically remind employees of the anti-bribery policy during departmental meetings, without any formal documentation of these reminders or feedback mechanisms. Option C. The organization actively disseminates its anti-bribery policy and objectives through multiple channels, including mandatory employee training, updates in onboarding materials for new hires, inclusion in key supplier contracts, and publication on its public-facing website for transparency. Option D. The organization has translated its anti-bribery policy into several languages and displays it prominently in all office locations, assuming that physical presence ensures awareness among all personnel. The correct answer is C. The organization actively disseminates its anti-bribery policy and objectives through multiple channels, including mandatory employee training, updates in onboarding materials for new hires, inclusion in key supplier contracts, and publication on its public-facing website for transparency. Explanation: the question probes the auditor's role in verifying the implementation of an organization's anti-bribery commitments, specifically under Clause 8.5 of ISO 37001-2016. This clause mandates that an organization shall make its anti-bribery policy and objectives known to those working for it and to external parties, where appropriate. The auditor's task is to assess whether this communication has been effectively carried out. This involves looking for evidence that the policy and objectives are not just documented, but are actively disseminated and understood by relevant stakeholders. For example, the auditor would examine records of training sessions, internal communications, website publications, and contractual clauses that reference the anti-bribery policy. The effectiveness is judged by the extent to which these communications are accessible and comprehensible to the intended audience, thereby fostering an anti-bribery culture. The auditor must consider how the organization ensures that its commitments are understood by personnel, business associates, and potentially other interested parties, as stipulated by the standard. This goes beyond mere existence of a policy to its practical application and awareness. Question 12. When conducting an audit of an organization's anti-bribery management system, which of the following approaches best reflects the auditor's responsibility in evaluating the comprehensiveness and effectiveness of the bribery risk assessment process as mandated by ISO 37001-2016, Clause 8? 3. Option A. Reviewing the financial records to identify any instances where gifts, hospitality, or travel expenses exceeded predefined thresholds, assuming this is the primary indicator of bribery risk. Option B. Verifying that the risk assessment considered the organization's operating environment, including geographic locations, industry sector, and key business relationships, and documented the methodology used to identify and evaluate bribery risks across all levels and functions. Option C. Confirming that the organization has a written policy explicitly prohibiting all forms of bribery, regardless of the specific risk factors identified in their assessment. Option D. Assessing the number of training sessions conducted on anti-bribery awareness for employees, assuming a higher number of sessions directly correlates with a lower residual bribery risk. Correct answer is B. Verifying that the risk assessment considered the organization's operating environment, including geographic locations, industry sector, and key business relationships, and documented the methodology used to identify and evaluate bribery risks across all levels and functions. Explanation. The effectiveness of an anti-bribery management system, ABAMS, relies heavily on its ability to identify and assess potential bribery risks. ISO 37001, 2016, Clause 8. 3. Mandates that an organization shall determine and assess bribery risks that it faces and consider all bribery risks from the perspective of the organization's objectives. This process involves understanding the context in which the organization operates, including its geographic locations, industry sector, business relationships, and the specific types of transactions and activities undertaken. A comprehensive risk assessment should consider both internal and external factors that could increase the likelihood or impact of bribery. External factors might include the prevalence of corruption in specific jurisdictions, the influence of third parties, and the nature of government interactions. Internal factors could involve the organization's own policies, procedures, internal controls, and the ethical culture among its employees and associates. The assessment should also differentiate between direct bribery and indirect bribery, as well as facilitation payments and gifts, hospitality and entertainment, understanding how each category might manifest and present a risk. The analysis should consider the potential consequences of bribery, such as financial penalties, reputational damage, and legal sanctions, as well as the likelihood of such events occurring. The ultimate goal is to establish a prioritized list of risks that can then inform the design and implementation of appropriate controls. Question 13. During an audit of a multinational corporation's anti-bribery management system, an auditor is reviewing the effectiveness of internal and external communication processes as mandated by ISO 37001-2016. The corporation has a diverse workforce across multiple jurisdictions with varying legal and cultural contexts. The auditor observes that while the anti-bribery policy has been translated into several languages and distributed electronically, there is no documented process for verifying comprehension or for external stakeholders to provide feedback on the policy's clarity or accessibility. Furthermore, a recent incident involving a third-party agent in a high-risk country was not proactively communicated internally to relevant compliance personnel until after the issue escalated. What is the most significant deficiency in the organization's communication processes concerning the anti-bribery management system? Option A. The reliance on electronic distribution of the anti-bribery policy without considering the digital literacy of all employees in diverse geographical locations. Option B. The delay in communicating the third-party agent incident internally, which indicates a breakdown in operational communication rather than a systemic issue with the anti-bribery management system's communication framework. Option C. Lack of a structured mechanism to confirm understanding of the anti-bribery policy across different linguistic and cultural groups, and an absence of formal channels for external feedback on the policy's effectiveness. Option D. Insufficient evidence of proactive communication to external stakeholders about the organization's commitment to anti-bribery, despite the policy's translation. The correct answer is C. Lack of a structured mechanism to confirm understanding of the anti-bribery policy across different linguistic and cultural groups, and an absence of formal channels for external feedback on the policy's effectiveness. Explanation: ISO 37001, 2016 Clause 8. 2 outlines the requirements for competence, training, and awareness. An auditor assessing an organization's anti-bribery management system must verify that individuals performing work under the organization's control that could affect its anti-bribery performance are competent on the basis of appropriate education, training, or experience. This competence must be maintained and evaluated. For internal communication, the standard requires the organization to communicate information relevant to the anti-bribery management system to relevant parties within the organization. This includes the anti-bribery policy and procedures. The effectiveness of these communications is crucial. For external communication, the organization must communicate relevant information about its anti-bribery management system to external interested parties, as determined by the organization. This communication should be appropriate to the nature, scope, and complexity of the organization's activities. An auditor would look for evidence that these communication channels are established, maintained, and that the content is accurate and disseminated effectively to foster an anti-bribery culture. The auditor needs to confirm that the mechanisms for receiving and responding to feedback from internal and external stakeholders regarding bribery risks and controls are in place and functional. This includes ensuring that reporting channels are accessible and that responses are timely and appropriate, aligning with the principle of continuous improvement inherent in the ISO 37001 framework. Question 14. When auditing an organization's anti-bribery management system, what is the primary focus of an auditor when evaluating compliance with Clause 5? 3. Organizational roles, responsibilities, and authorities, particularly concerning the designated bribery prevention officer. Option A. Ensuring that the bribery prevention officer is solely responsible for all aspects of the anti-bribery management system, with no delegation to other departments or individuals. Option B. Verifying that the bribery prevention officer has clearly defined responsibilities, appropriate authority to execute those responsibilities, and reports directly to top management or a designated representative. Option C. Assessing whether the bribery prevention officer's compensation is directly tied to the number of reported bribery incidents, irrespective of their severity or outcome. Option D. Confirming that the bribery prevention officer possesses a minimum of 10 years of experience in compliance and has completed advanced certifications in forensic accounting. The correct answer is B. Verifying that the bribery prevention officer has clearly defined responsibilities, appropriate authority to execute those responsibilities, and reports directly to top management or a designated representative. Explanation: Clause 5. 3 of ISO 37001 2016, Organizational Roles, Responsibilities, and Authorities, mandates that top management ensure that relevant roles within the organization are assigned, communicated, and understood. This includes defining who is responsible for establishing, implementing, maintaining, and improving the anti-bribery management system ABAMS. While the ultimate responsibility for the ABAMS rests with top management, the standard permits the delegation of specific tasks and oversight to individuals or groups. The designated bribery prevention officer, or similar title, is a key role often established to manage the day-to-day operations of the ABAMS. This individual typically reports to top management and is empowered to oversee policy implementation, training, risk assessments, and reporting mechanisms. Their authority should be sufficient to ensure compliance and address nonconformities effectively. The specific reporting lines and levels of authority can vary based on the organization's size, complexity, and structure, but the principle of clear assignment and communication of responsibility and authority remains paramount for an effective ABAMS. The auditor's role is to verify that these roles and authorities are adequately defined, documented, and understood throughout the organization, and that the designated individuals possess the necessary resources and mandate to fulfill their responsibilities. This includes reviewing organizational charts, job descriptions, and meeting minutes where responsibilities are discussed and assigned. Question 15. An auditor is reviewing an organization's anti-bribery management system, which has significant operations in the United States and several countries that are signatories to the OECD Convention on Combating Bribery of Foreign Public Officials in International Business Transactions. The organization's policies and procedures are largely based on ISO 37001/2016, but the auditor needs to assess the system's effectiveness in light of specific jurisdictional requirements. Considering the extraterritorial reach and enforcement focus of major anti-bribery legislation, which of the following regulatory frameworks would an auditor primarily need to ensure is adequately addressed within the organization's controls and compliance monitoring, beyond the general principles of ISO 37001/2016? Option A, the U.S. Foreign Corrupt Practices Act (FCPA) and its implications for payments to foreign officials and record keeping. Option B, the local labor laws in each country of operation regarding employee conduct and reporting of misconduct. Option C, the UK Bribery Act 2010, specifically its provisions on facilitation payments and corporate hospitality. Option D, the European Union's General Data Protection Regulation, GDPR, concerning the handling of sensitive information during investigations. The correct answer is A, the U.S. Foreign Corrupt Practices Act (FCPA) and its implications for payments to foreign officials and record keeping. Explanation: the Foreign Corrupt Practices Act (FCPA) is a United States federal law that prohibits U.S. persons and entities from bribing foreign government officials. It also requires publicly traded companies to maintain accurate books and records and to have internal accounting controls. When auditing an organization that operates internationally, an auditor must consider how the organization's anti-bribery management system aligns with key anti-bribery legislation in the jurisdictions where it operates. The FCPA, for instance, has specific provisions regarding payments to foreign officials, which directly impact the scope and focus of due diligence and internal controls related to third-party relationships and financial transactions. An auditor would look for evidence that the organization has identified relevant foreign anti-bribery laws, such as the FCPA, and has implemented controls and procedures that are designed to prevent and detect violations of these laws. This includes assessing the effectiveness of due diligence on third parties who may act on the organization's behalf in foreign countries, the clarity of policies on gifts, hospitality, and entertainment, and the robustness of financial record keeping to ensure transparency and prevent off-book accounts that could facilitate bribery. Understanding the extraterritorial reach of laws like the FCPA is crucial for an auditor to determine the adequacy of the anti-bribery management system in addressing all applicable legal and regulatory requirements. Question 16. When assessing bribery risks for a multinational logistics company that frequently engages third-party freight forwarders and operates in jurisdictions with varying levels of regulatory enforcement, which of the following internal and external factors would an ISO 37001/2016 auditor prioritize for in-depth examination to identify potential bribery vulnerabilities? Option A, the company's reliance on performance-based commissions for sales representatives and the frequency of its business dealings with state-owned enterprises in high-risk countries. Option B, the number of formal complaints received regarding ethical conduct and the company's annual investment in corporate social responsibility initiatives. Option C, the complexity of the company's supply chain management software and the average tenure of its human resources department personnel. Option D, the extent of employee training on the ABAMS and the company's historical profit margins in stable economic regions. The correct answer is A, The company's reliance on performance-based commissions for sales representatives and the frequency of its business dealings with state-owned enterprises in high-risk countries. Explanation: the identification of bribery risks is a fundamental component of establishing an effective anti-bribery management system (ABAMS), as mandated by ISO 37001-2016. Clause 8. 3. Risk assessment specifically requires an organization to identify and assess bribery risks. This process involves considering various factors that could increase the likelihood or impact of bribery. These factors are often categorized into internal and external influences. Internal factors relate to the organization's own operations, policies, and people, while external factors pertain to the environment in which the organization operates, including the jurisdiction, business partners, and economic conditions. A comprehensive risk assessment would consider the nature of the organization's business, its geographic locations, the types of transactions it engages in, the involvement of third parties, and the susceptibility of its processes to manipulation. For instance, operating in countries with weak anti-bribery laws or high corruption perception indices presents a higher external risk. Similarly, relying heavily on intermediaries with opaque business practices or engaging in cash-intensive transactions can introduce significant internal risks. The effectiveness of existing controls, the tone at the top, and the awareness of employees also play a crucial role in shaping the overall risk profile. Therefore, a holistic approach that scrutinizes both the internal workings and the external operating landscape is essential for accurately identifying and prioritizing bribery risks. Question 17. When formulating the internal audit program for an organization operating in high-risk jurisdictions and engaged in complex international procurement, what is the most crucial factor an ISO 37001-2016 auditor must prioritize during the planning phase to ensure the audit's effectiveness in identifying potential bribery vulnerabilities? Option A. Focusing solely on documented policy adherence without investigating the practical implementation and behavioral aspects of anti-bribery controls. Option B. Prioritizing audit areas based on a thorough risk assessment of specific business processes, geographical locations, and third-party relationships known to have higher bribery probabilities. Option C. Conducting audits at a fixed, predetermined frequency for all departments, irrespective of their inherent risk profile or recent performance. Option D. Scheduling audits exclusively for departments that have experienced recent employee turnover, assuming this correlates directly with increased risk. The correct answer is B. Prioritizing audit areas based on a thorough risk assessment of specific business processes, geographical locations, and third-party relationships known to have higher bribery probabilities. Explanation: the planning of an internal audit for an anti-bribery management system, as per ISO 37001-2016, requires a systematic approach that considers the organization's specific context, risks, and the effectiveness of its existing controls. Clause 9. Two of the standard mandates that internal audits are conducted at planned intervals to provide information on whether the anti-bribery management system conforms to the organization's own requirements and the requirements of the standard, and whether it is effectively implemented and maintained. The auditor must consider the results of previous audits, the status of corrective actions, and the overall risk assessment when determining the scope, frequency, and methodology of subsequent audits. This involves evaluating the potential for bribery in different business units, geographical areas, and transaction types. A key aspect of effective planning is to ensure that the audit program covers all relevant aspects of the anti-bribery management system over a defined period, such as a 3-year cycle, while also allowing for responsive audits based on emerging risks or incidents. The auditor's role is to ensure the audit plan is comprehensive, risk-based, and provides sufficient coverage to assess the system's performance and identify areas for improvement. This includes considering the competence of the audit team and the resources required to conduct the audits effectively. The plan should be documented and communicated to relevant parties. Question 18. During an audit of a multinational corporation's anti-bribery management system, an auditor is assessing the competence of personnel involved in high-risk transactions. The organization has provided training records indicating that the sales team, which frequently engages with third-party agents in jurisdictions with high corruption perception indices, has completed a general anti-bribery awareness module. However, the auditor notes that the specific training did not cover the nuances of due diligence for third-party agents or the detailed procedures for escalating suspicious transaction indicators, which are critical for this particular team's function. Considering ISO 37001-2016 Clause 7. 2. What is the most appropriate finding for the auditor to record regarding the competence of this sales team? Option A. Opportunity for improvement. The organization should consider developing advanced training modules for its sales team that delve deeper into the practical application of due diligence for third-party agents and the reporting of suspicious activities to better align with best practices. Option B. Nonconformity. The training provided to the sales team lacks the specific knowledge and skills required to effectively manage bribery risks associated with third-party agent engagements, failing to meet the competence requirements of Clause 7. 2. Option C. Conformity. The sales team has met the minimum training requirements as per the ABAM's documentation, and the auditor cannot mandate specific content beyond the general awareness provided. Option D. Observation. The sales team has completed general anti-bribery training, which is a positive step, but further specialized training on third-party due diligence and transaction monitoring might enhance their risk management capabilities. The correct answer is B. Nonconformity. The training provided to the sales team lacks the specific knowledge and skills required to effectively manage bribery risks associated with third-party agent engagements, failing to meet the competence requirements of Clause 7. 2. Explanation. The effectiveness of an anti-bribery management system, ABAMS, hinges on the competence of personnel involved in its implementation and operation. Clause 7.2 of ISO 37001, 2016. Competence mandates that an organization shall determine the necessary competence for personnel affecting the ABAM's performance. This includes those responsible for implementing, operating, and overseeing the system. The process involves identifying the required skills, knowledge, and experience. Subsequently, the organization must ensure that these personnel are competent through appropriate education, training, or experience. Crucial aspect for an auditor is to verify that the organization has a systematic approach to assessing and maintaining this competence. This includes having documented procedures for competence assessment, records of training and qualifications, and mechanisms for evaluating the effectiveness of training. For an auditor, verifying the adequacy of the training provided to key personnel, such as the designated anti-bribery compliance officer or internal audit team members, is paramount. This involves reviewing training materials, attendance records, and post-training assessments to ensure that individuals possess the necessary understanding of anti-bribery laws, organizational policies, risk assessment methodologies, and the practical application of ABAM's controls. The focus is on demonstrating that personnel have the requisite capabilities to perform their roles effectively in preventing, detecting, and responding to bribery risks. Question 19. When assessing an organization's anti-bribery management system for adherence to ISO 37001, 2016, particularly concerning the foundational element of fostering an ethical culture, which of the following audit findings would most strongly indicate a potential weakness in the system's overall effectiveness, even if other controls appear operational? Option A. A recent internal audit identified a gap in the mandatory completion rate of anti-bribery training modules for a specific department, with approximately 85% completion. Option B. The organization has a well-documented whistleblowing policy and a functional reporting hotline, but no recorded instances of employees utilizing the hotline in the past 2 years. Option C. Evidence suggests that senior leadership's public statements on ethical conduct are infrequent and lack specific examples of how anti-bribery principles are applied in challenging business situations. Option D. The organization's third-party due diligence process has identified a minor discrepancy in a supplier's registration documents that has not yet been fully investigated. The correct answer is C. Evidence suggests that senior leadership's public statements on ethical conduct are infrequent and lack specific examples of how anti-bribery principles are applied in challenging business situations. Explanation. The establishment of an anti-bribery culture within an organization is fundamentally driven by leadership commitment, which permeates throughout the entire structure. This commitment is not merely a declaration, but is demonstrated through consistent actions and the allocation of resources. ISO 37001, 2016 Clause 5. 1. Leadership and commitment emphasizes that top management shall demonstrate leadership and commitment with respect to the anti-bribery management system by taking accountability for the effectiveness of the system. This includes ensuring that the anti-bribery policy and objectives are established and are compatible with the strategic direction of the organization. Furthermore, Clause 5(2) policy requires that top management shall establish an anti-bribery policy that is appropriate to the purpose, size, and context of the organization and its bribery risks. This policy should also include a commitment to fulfill applicable requirements and to continual improvement of the anti-bribery management system. The tone from the top is critical in shaping employee perceptions and behaviors regarding bribery. Without visible and active support from senior leadership, initiatives aimed at fostering an ethical culture are likely to be perceived as superficial or not genuinely prioritized, undermining their effectiveness. While other elements like training, reporting mechanisms, and due diligence are vital components of an anti-bribery management system, they derive their ultimate effectiveness and perceived importance from the foundational commitment demonstrated by leadership. This commitment sets the tone, allocates necessary resources, and ensures that anti-bribery principles are integrated into the organization's values and operations. Question 20. An auditor is evaluating the effectiveness of an anti-bribery management system for a multinational corporation with significant operations in a country known for its lax enforcement of anti-bribery legislation. The corporation has identified a high risk of bribery within its procurement department, particularly concerning the selection of suppliers for critical raw materials. Which of the following implemented non-financial controls would be considered the most critical and impactful in directly mitigating this specific procurement-related bribery risk, given the external enforcement environment? Option A. The company's stated commitment to ethical conduct, communicated through annual all-staff awareness sessions that briefly touch upon bribery prevention. Option B. Rigorous, documented due diligence and ongoing monitoring of all third-party suppliers, including verification of their business practices and beneficial ownership, coupled with a transparent, multi-stage supplier selection process with defined approval hierarchies and segregation of duties for contract finalization. Option C. The establishment of a confidential reporting hotline for employees to report suspected bribery, with a policy that offers protection against retaliation for whistleblowers. Option D. A detailed financial audit program that includes sample testing of vendor payments for unusual patterns or discrepancies, performed by an independent internal audit function. The correct answer is B. Rigorous, documented due diligence and ongoing monitoring of all third-party suppliers, including verification of their business practices and beneficial ownership, coupled with a transparent, multi-stage supplier selection process with defined approval hierarchies and segregation of duties for contract finalization. Explanation. The question probes the auditor's understanding of how non-financial controls contribute to an anti-bribery management system's effectiveness, specifically in a scenario involving a company operating in a jurisdiction with weak enforcement of anti-bribery laws. ISO 37001, 2016 emphasizes that controls should be proportionate to the bribery risks identified. Non-financial controls, such as robust due diligence on third parties, clear communication of ethical standards through training and policies, and a transparent process for handling hospitality and gifts, are crucial in mitigating bribery risks where legal frameworks might be less robust. These controls create an internal environment that discourages bribery and provides mechanisms for detection and reporting, even if external enforcement is lax. The integrity of procurement processes, including segregation of duties and independent review of vendor selection, is a prime example of a non-financial control that directly addresses the risk of procurement-related bribery. This control makes it significantly harder for bribes to influence purchasing decisions or for kickbacks to be concealed within vendor agreements. The other options, while potentially related to anti-bribery efforts, are less direct or less impactful as primary non-financial controls in this specific context. For instance, relying solely on the company's reputation is a passive measure, and while financial audits are important, they are a form of financial control and often detect issues after they have occurred, whereas the question focuses on preventative non-financial controls. A comprehensive whistleblower policy is vital, but is one component of a broader control environment, and its effectiveness hinges on other controls that prevent the underlying bribery from occurring in the first place. Question 21. When auditing an organization's anti-bribery management system against ISO 37001-2016, an auditor is reviewing the documented procedures for offering and receiving gifts, hospitality, and other benefits. The organization operates in multiple jurisdictions, including one with stringent anti-bribery legislation that criminalizes even the appearance of impropriety when dealing with public officials, regardless of direct intent to bribe. How should the auditor assess the adequacy of the organization's internal procedures in this context? Option A. Confirm that the organization's legal counsel has reviewed the procedures, assuming their approval guarantees compliance with all applicable international anti-bribery laws. Option B. Verify that the procedures explicitly prohibit any form of gift or hospitality, as this is the most conservative approach to prevent any potential legal contravention. Option C. Check if the procedures include a disclaimer stating that the organization is not liable for any actions taken by employees that may violate local anti-bribery laws, shifting the responsibility solely to the individual. Option D. Evaluate whether the procedures establish clear thresholds and approval workflows for all gifts and hospitality, ensuring they are proportionate, documented, and do not create an undue influence, considering the specific legal prohibitions against the appearance of impropriety in relevant jurisdictions. Correct answer is D. Evaluate whether the procedures establish clear thresholds and approval workflows for all gifts and hospitality, ensuring they are proportionate, documented, and do not create an undue influence, considering the specific legal prohibitions against the appearance of impropriety in relevant jurisdictions. Explanation. The question probes the auditor's understanding of how an organization's internal policies and procedures for gifts, hospitality, and entertainment should align with external legal and regulatory frameworks, specifically concerning potential bribery. ISO 37001-2016 Clause 7. 2. Gifts, hospitality, donations, and other benefits mandates that an organization establish, implement, and maintain procedures for offering and receiving such items. These procedures must prohibit bribery and corruption and be designed to prevent their occurrence. Crucially, these internal procedures must also consider and be consistent with applicable laws and regulations. The UK Bribery Act 2010, for instance, makes it an offence to offer, promise, or give a bribe, and also to request, agree to receive, or accept a bribe. It also includes a specific offense of bribing a foreign public official and a failure to prevent bribery offense. An auditor must assess whether the organization's policy on gifts, hospitality, and entertainment, which may include monetary thresholds or approval processes, is robust enough to prevent actions that could be construed as bribery under such legislation. For example, if an organization's policy allows for gifts of significant value without adequate due diligence on the recipient's position or the context, it could inadvertently facilitate bribery, even if not explicitly intended. The auditor's role is to verify that the controls are designed and implemented effectively to mitigate this risk, ensuring that the internal framework acts as a barrier against illegal conduct by considering the broader legal landscape. The scenario highlights the need for an auditor to evaluate the adequacy of internal controls in light of external legal obligations, specifically how the organization's defined procedures for gifts and hospitality are designed to prevent contraventions of anti-bribery laws like the UK Bribery Act 2010. Question 22. Consider a multinational corporation, Global Tech Solutions, operating in several jurisdictions with varying anti-bribery legislation, such as the UK Bribery Act and the US Foreign Corrupt Practices Act. During an audit of Global Tech's ISO 37001-2016 compliant anti-bribery management system, an auditor observes that while the CEO has publicly endorsed the anti-bribery policy, the operational divisions have not fully integrated the policy into their daily procurement and sales processes. Furthermore, the budget allocated for anti-bribery training in the upcoming fiscal year has been significantly reduced, and there is no clear indication of how the top management intends to ensure the system's effectiveness in the face of these resource constraints and operational disconnects. Which of the following most accurately reflects a potential deficiency in leadership and commitment, as per ISO 37001-2016 Clause 5? 1. Option A. The reduction in training budget is a matter for financial audit, not an anti-bribery management system audit concerning leadership commitment. Option B. The visible endorsement of the policy is insufficient without demonstrable integration into operational processes and adequate resource allocation for critical functions like training. Option C. The auditor should focus solely on the CEO's public statements, as Clause 5.1 primarily concerns top management's communication of intent. Option D. Operational divisions are solely responsible for policy integration, and top management's role is limited to policy approval and communication. The correct answer is B. The visible endorsement of the policy is insufficient without demonstrable integration into operational processes and adequate resource allocation for critical functions like training. Explanation: ISO 37001, 2016 Clause 5.1. Leadership and commitment mandates that top management demonstrate visible leadership and commitment to the anti-bribery management system. This commitment is not merely a statement of intent, but requires active involvement and integration of the system into the organization's business processes. Key aspects include establishing the anti-bribery policy, ensuring objectives are set, promoting a risk-based approach, ensuring resources are available, communicating the importance of effective bribery prevention, and ensuring the system achieves its intended outcomes. The clause emphasizes that leadership must foster a culture where bribery is unacceptable, and where individuals feel empowered to report concerns without fear of reprisal. This involves actively championing the system, allocating appropriate personnel and financial resources, and ensuring the system's integration into the overall business strategy and operations. The effectiveness of the anti-bribery management system is directly linked to the visible and sustained commitment demonstrated by top management in these areas. Question 23. An auditor conducting a review of a multinational corporation's financial records, operating under an ISO 37001-2016 certified anti-bribery management system, discovers a decentralized petty cash system across various regional offices. One particular office maintains a no questions asked petty cash fund for minor operational expenses, with a monthly disbursement limit of $500, requiring only a signature from the recipient and the disbursing officer. What is the primary implication of this specific financial control mechanism in relation to the organization's anti-bribery commitments? Option A. It significantly undermines the transparency and accountability required for effective bribery prevention and detection. Option B. It is a permissible exception under ISO 37001-2016 for managing low-value operational costs. Option C. It demonstrates a commitment to operational efficiency by streamlining minor expense processing. Option D. It is a common and accepted practice in industries with high volumes of small transactions. The correct answer is A. It significantly undermines the transparency and accountability required for effective bribery prevention and detection. Explanation: the scenario describes a situation where an auditor is reviewing financial transactions for potential bribery. ISO 37001-2016, specifically Clause 8.3, mandates that organizations implement controls to prevent bribery. This includes financial controls designed to identify and deter illicit payments. When examining expense reports, an auditor would look for deviations from established policies, unusual patterns, or lack of proper documentation that could indicate a bribe. The purpose of a no questions asked petty cash fund, by its very nature, bypasses the scrutiny and detailed record-keeping required by robust anti-bribery financial controls. Such a fund inherently lacks the transparency and accountability necessary to prevent or detect bribery, as it permits expenditures without requiring justification or detailed substantiation, thereby creating a significant risk of misuse for illicit purposes. Therefore, the existence of such a fund directly contravenes the principles of financial transparency and control essential for an effective anti-bribery management system. The auditor's role is to identify such systemic weaknesses. Question 24. During an audit of an organization's anti-bribery management system, an auditor is reviewing the procedures for assessing the bribery risk associated with engaging new suppliers. The organization has a tiered approach to supplier due diligence, categorizing suppliers based on factors like geographic location, industry sector, and the nature of the services provided. The auditor finds that, while high-risk suppliers undergo extensive background checks, including verification of beneficial ownership and past compliance records. Medium-risk suppliers are only subjected to a basic online search and a review of their company registration documents. The organization's policy states that due diligence should be proportionate to the risk. Which of the following best reflects the auditor's assessment of compliance with ISO 37001-2016 Clause 7? 2. Considering the principle of proportionality. Option A. The organization's due diligence for medium-risk suppliers is insufficient, as the standard requires a consistent level of detailed investigation for all third parties to prevent any potential bribery. Option B. The organization's due diligence process appears to align with the principle of proportionality by applying more rigorous checks to high-risk suppliers, while low-risk engagements receive a commensurately reduced level of scrutiny. Option C. The organization must implement enhanced due diligence for all suppliers, regardless of risk assessment, to fully comply with the standard's intent. Option D. The auditor should recommend that the organization conduct a full forensic audit on all medium-risk suppliers to ensure absolute certainty of their integrity. The correct answer is B. The organization's due diligence process appears to align with the principle of proportionality by applying more rigorous checks to high-risk suppliers, while low-risk engagements receive a commensurately reduced level of scrutiny. Explanation. The core principle tested here is the auditor's role in verifying the effectiveness of an organization's due diligence processes for third parties, as mandated by ISO 37001-2016 Clause 7. 2. This clause requires organizations to conduct due diligence on persons or entities that provide or may provide services on behalf of the organization, or that act on its behalf in relation to its business. The purpose of due diligence is to assess the risk of bribery associated with these relationships. An auditor must evaluate whether the organization has established and is applying procedures to identify and assess these risks. This involves examining the criteria used for due diligence, the depth of the investigation based on risk, and the documented outcomes of these assessments. Specifically, the auditor looks for evidence that the organization has considered factors such as the nature of the relationship, the jurisdiction, the third party's reputation, and any previous associations with bribery or corruption. The auditor's objective is to confirm that the due diligence process is proportionate to the identified bribery risks and that appropriate controls are implemented based on the findings. This includes verifying that the organization has a system for categorizing third parties by risk level and applying more rigorous due diligence to higher-risk relationships, as well as ensuring that the results of due diligence inform decisions about engaging or continuing relationships with third parties. The effectiveness is measured by whether the process adequately identifies and mitigates potential bribery risks stemming from these third-party interactions, thereby supporting the overall anti-bribery management system. Question 25. During an audit of a manufacturing firm's compliance with ISO 37001-2016, an auditor discovers evidence that a senior sales executive provided a government procurement officer involved in evaluating bids for a significant contract with a fully paid luxury vacation package to a popular tourist destination. The procurement officer had not yet made a final decision on the contract. Which specific aspect of bribery, as understood by ISO 37001-2016 and relevant anti-bribery legislation like the UK Bribery Act 2010, does this action most directly represent? Option A. Soliciting a bribe to expedite a regulatory approval. Option B. Accepting a facilitation payment to bypass bureaucratic procedures. Option C. Offering an undue advantage to improperly influence a decision. Option D. Laundering illicit funds obtained through corrupt practices. The correct answer is C. Offering an undue advantage to improperly influence a decision. Explanation. The scenario describes a situation where a company's representative offers a travel and accommodation package to a government official to influence a procurement decision. This action directly aligns with the definition of bribery as an inducement or reward offered to a public official or other person in a position of trust to act improperly. ISO 37001-2016 Clause 8. 2. Bribery by the organization requires the organization to prevent, detect, and report bribery. Specifically, the standard prohibits offering, promising, giving, accepting, or soliciting bribes, which includes inappropriate gifts, hospitality, or other benefits that could be construed as influencing a decision. The offering of a travel and accommodation package, particularly in the context of an ongoing procurement process, constitutes a clear violation of these principles, as it is designed to gain an unfair advantage and corruptly influence the official's judgment. The auditor's role is to identify such practices as nonconformities with the anti-bribery management system. The core of the issue is the intent and the potential for undue influence, irrespective of whether the official ultimately accepts the offer or if the procurement decision is indeed altered. The act of offering itself is the breach. Question 26. An auditor is evaluating an organization's adherence to ISO 37001-2016, specifically focusing on the initial phase of establishing the anti-bribery management system. The organization has identified its primary regulatory obligations under the UK Bribery Act 2010 and the US Foreign Corrupt Practices Act, and has documented employee expectations regarding ethical conduct. However, during the audit, it becomes apparent that the organization has not systematically considered the expectations of its significant overseas joint venture partners regarding the transparency of financial transactions, or the requirements of investors who have explicitly stated a preference for companies with robust third-party due diligence processes beyond basic compliance. Which aspect of understanding the needs and expectations of interested parties has the organization most significantly overlooked in its ISO 37001-2016 implementation? Option A. The comprehensive translation of all identified interested party needs into legally binding contractual clauses within all business agreements. Option B. The systematic identification and consideration of all relevant interested parties and their specific anti-bribery related requirements and expectations, including those of strategic partners and financial stakeholders. Option C. The exclusive focus on statutory and regulatory requirements as the sole determinants of interested party expectations for an anti-bribery management system. Option D. The delegation of the responsibility for identifying interested party needs solely to the internal audit department without cross-functional input. The correct answer is B. The systematic identification and consideration of all relevant interested parties and their specific anti-bribery related requirements and expectations, including those of strategic partners and financial stakeholders. Explanation. The core of understanding interested parties' needs and expectations under ISO 37001-2016 involves identifying who they are, what they require or expect concerning anti-bribery, and how these requirements can be translated into the organization's anti-bribery management system. This process is foundational to establishing the scope and objectives of the system. For an auditor, assessing this requires looking beyond mere documentation to the practical implementation and integration of these identified needs. An auditor would verify that the organization has a systematic approach to identifying relevant interested parties, such as regulators, e.g., the UK Bribery Act 2010, the US Foreign Corrupt Practices Act, business partners, employees, and shareholders. The auditor would then examine how the organization determines which of these needs and expectations are relevant to its anti-bribery commitments and how they are communicated and considered within the system. This involves reviewing meeting minutes, communication logs, risk assessments, and policy development processes. The effectiveness of the system is judged by its ability to proactively address potential bribery risks, informed by these external and internal perspectives, ensuring that the system's design and operation are aligned with stakeholder concerns and regulatory mandates. For instance, if a key supplier expects stringent due diligence on third parties, this expectation must be demonstrably incorporated into the organization's third-party risk management procedures. The organization's commitment to transparency and ethical conduct, often a key expectation of investors and the public, must also be evident in its policies and public disclosures. Therefore, the auditor's focus is on the documented evidence of this identification and consideration process and its tangible impact on the anti-bribery controls. Question 27. An auditor is evaluating the anti-bribery management system of a global logistics firm, Swift Ship Couriers, which operates in several jurisdictions with varying corruption perceptions indices. Swift Ship Couriers has implemented a system that includes mandatory anti-bribery training, third-party due diligence, and a confidential reporting hotline. The auditor is reviewing the key performance indicators, KPI, used by SwiftShip to measure the ABM's effectiveness in preventing bribery. Which of the following KPIs would most directly demonstrate the effectiveness of SwiftShip's preventative measures, aligning with the proactive intent of ISO 37001-2016? Option A. Number of disciplinary actions taken against employees for violations of the anti-bribery policy. Option B. Percentage of high-risk third-party relationships that have undergone enhanced due diligence and possess signed anti-bribery compliance statements. Option C. Total number of reported bribery allegations received through the confidential hotline over the past fiscal year. Option D. Average time taken to investigate reported bribery allegations from initial receipt to closure. The correct answer is B. Percentage of high-risk third-party relationships that have undergone enhanced due diligence and possess signed anti-bribery compliance statements. Explanation. The effectiveness of an anti-bribery management system, ABMS, is often gauged by monitoring key performance indicators, KPI, that reflect the system's proactive and reactive controls. ISO 37001-2016 emphasizes the importance of monitoring, measurement, analysis, and evaluation. When assessing the performance of an ABMS, auditors need to consider indicators that demonstrate the system's ability to prevent, detect, and respond to bribery risks. A robust ABMS will have KPIs that track the implementation and effectiveness of its controls, such as the percentage of employees who have completed anti-bribery training, the number of due diligence checks conducted on third parties, and the number of reported bribery concerns. However, a KPI that solely focuses on the number of reported incidents, without considering the context or the effectiveness of the reporting mechanism and subsequent investigation, can be misleading. For instance, a high number of reports might indicate increased awareness and trust in the reporting channels, or it could signify a systemic issue. Conversely, a low number of reports might suggest effective prevention or a failure in detection and reporting. Therefore, to truly measure the effectiveness of the ABMS in preventing bribery, a more comprehensive approach is needed. Measuring the proportion of high-risk third parties who have undergone enhanced due diligence and have signed anti-bribery declarations, and tracking the completion rate of risk assessments for critical business processes are more direct indicators of proactive prevention efforts. These metrics demonstrate that the organization is actively identifying and mitigating bribery risks before they materialize, which is a core objective of an effective ABMS. Question 28. An auditor is reviewing the anti-bribery compliance program of a multinational corporation that utilizes numerous overseas distributors. During the audit, it is discovered that a significant distributor in a high-risk jurisdiction has recently been penalized by local authorities for engaging in practices that, while not directly proven to be bribery, demonstrate a pattern of circumventing regulatory requirements and a general disregard for ethical business conduct. The distributor's internal policies appear superficial and lack robust enforcement mechanisms for anti-bribery commitments. What is the most appropriate course of action for the corporation to take in accordance with ISO 37001-2016 principles to address this situation with the distributor? Option A. Request the distributor to provide a written statement of their commitment to anti-bribery principles, assuming this will be sufficient to mitigate the identified risks and allow the relationship to continue unchanged. Option B. Terminate the business relationship with the distributor without further discussion, citing the potential reputational damage and legal exposure to the corporation. Option C. Immediately require the distributor to implement specific, documented corrective actions to strengthen their anti-bribery controls and monitor their progress, while simultaneously conducting a heightened risk assessment of the relationship. Option D. Accept the distributor's explanation that the local penalties were due to misunderstandings of complex regulations, and continue the business relationship with only a minor note in the internal audit report. The correct answer is C. Immediately require the distributor to implement specific, documented corrective actions to strengthen their anti-bribery controls and monitor their progress, while simultaneously conducting a heightened risk assessment of the relationship. Explanation. The core principle of assessing business associates under ISO 37001-2016 involves ensuring their commitment to anti-bribery principles aligns with the organization's own. Clause 7. 2. 3 of the standard specifically addresses the due diligence of business associates. This clause mandates that an organization shall apply due diligence measures to business associates to manage bribery risks. The extent of due diligence should be proportionate to the identified bribery risks. When a business associate is found to have inadequate anti-bribery controls or a history of unethical conduct, the organization must take appropriate action. This action could range from requiring the business associate to implement specific improvements to terminating the relationship if the risks cannot be adequately mitigated. The goal is to prevent the organization from being implicated in bribery through its association with third parties. Therefore, the most effective response to a business associate demonstrating a clear lack of commitment or existing inadequate controls is to mandate corrective actions and monitor their implementation, rather than simply accepting the risk or immediately severing ties without an opportunity for remediation, unless the risk is deemed unmanageable. The scenario presented indicates a need for proactive intervention to bring the business associate's practices into alignment with the anti-bribery management system's objectives. Question 29. During an audit of a multinational corporation's anti-bribery management system, an auditor is evaluating the effectiveness of the mandatory anti-bribery training delivered to all employees. Clause 9. 1. 2 of ISO 37001-2016 mandates the monitoring, measurement, analysis, and evaluation of the system's performance, considering the objective of ensuring that employees understand and can apply anti-bribery principles. Which of the following metrics would provide the most direct and actionable insight into the immediate effectiveness of the training program itself? Option A. The number of distinct whistleblowing channels established and actively promoted to employees during the reporting period. Option B. The total number of bribery-related concerns reported through all available whistleblowing channels in the 6 months following the training. Option C. The percentage of employees who correctly identify and respond to hypothetical bribery scenarios presented in a post-training knowledge assessment. Option D. The frequency with which the senior management team reviews the documented anti-bribery policy and procedures. The correct answer is C. The percentage of employees who correctly identify and respond to hypothetical bribery scenarios presented in a post-training knowledge assessment. Explanation. The question asks to identify the most appropriate metric for an ISO 37001 auditor to assess the effectiveness of a company's anti-bribery training program, specifically focusing on Clause 9. 1. 2. Which deals with monitoring, measurement, analysis, and evaluation. An effective training program should demonstrably improve employee awareness and understanding of anti-bribery policies and procedures, leading to a reduction in reported incidents or a higher quality of reporting. Measuring the percentage of employees who correctly identify bribery scenarios in a post-training assessment directly evaluates the knowledge transfer and comprehension of the training content. This metric provides a tangible indicator of whether the training achieved its intended learning outcomes. Other metrics, while potentially useful, are less direct in assessing the immediate impact of the training itself. For instance, the number of reported bribery concerns, while a good overall indicator of the system's health, can be influenced by many factors beyond just training. The frequency of management reviews of the anti-bribery policy is a procedural element, not a direct measure of training effectiveness. Similarly, the number of whistleblowing channels established reflects the availability of reporting mechanisms, not necessarily the effectiveness of the training in encouraging their use or ensuring understanding. Therefore, assessing comprehension through scenario-based evaluations is the most precise way to gauge the immediate impact of the training on employee knowledge. Question 30. An ISO 37001-2016 auditor is reviewing an organization operating in a sector widely recognized for systemic corruption and bribery. The organization itself has a robust anti-bribery management system in place, with documented policies, training, and controls. However, the auditor observes that the organization is struggling to secure new business opportunities, despite having competitive products and services, and is experiencing significant pressure from some stakeholders to level the playing field. What is the most likely overarching consequence for the organization if it fails to adequately address the external corrupt environment and its potential influence on internal controls? Option A. Increased likelihood of internal control circumvention as employees perceive the need to engage in bribery to remain competitive, thereby undermining the anti-bribery management system's effectiveness. Option B, a temporary dip in market share that will naturally recover as market conditions improve and the organization's ethical stance becomes a competitive advantage. Option C, the necessity to revise its risk assessment methodology to focus solely on internal process failures, as external factors are beyond the scope of ISO 37001. Option D, a minor increase in operational costs due to the need for more rigorous due diligence on third parties, which is a standard compliance burden. The correct answer is A, increased likelihood of internal control circumvention, as employees perceive the need to engage in bribery to remain competitive, thereby undermining the anti-bribery management system's effectiveness. Explanation. The core of the question lies in understanding how systemic corruption can erode the foundational principles of a legitimate business and its societal standing, directly impacting an organization's ability to operate ethically and sustainably. Corruption becomes pervasive within an industry or region. It creates an uneven playing field. Competitors who engage in bribery gain an unfair advantage by securing contracts, licenses, or preferential treatment through illicit means, rather than through merit, quality, or competitive pricing. This distorts market mechanisms and can lead to the failure of honest businesses that cannot compete with the artificially lower costs or guaranteed wins of corrupt entities. For an ISO 37001 auditor, recognizing this broader impact is crucial. The standard's objective is to prevent, detect, and address bribery. A widespread corrupt environment makes achieving these objectives significantly more challenging. It increases the risk of employees being pressured or incentivized to engage in bribery to keep the business afloat or competitive. Furthermore, such an environment can lead to a decline in public trust, damage to brand reputation, and severe legal and financial penalties for the organization, even if it attempts to maintain an anti-bribery stance. The auditor must consider how the external corruption landscape might influence the internal effectiveness of the anti-bribery management system.